Hopefully tonight will be better. Has everyone read the chapter? Okay. So some people have read, some haven't looked at it yet, and that's to be expected. But it is Thursday night, so we'll try to get going. Okay, on Chapter 6, we're going to be talking about inventory and cost of goods sold. The different specific concepts we're going to talk about are how to account for inventory, how we're going to apply and compare the various inventory cost methods. We're going to explain and apply underlying GAAP, or generally accepted accounting principles, for inventory. We will then compute and evaluate gross profit margin percentage and inventory turnover, and then use the cost of goods sold model to help make management decisions. And then last but not least is analyze the effects of inventory errors, which is always kind of an eye-opening experience to students and new accountants at how long it takes for an error to correct itself once has been made. Okay. Flip my slides over. Okay, if you have specific questions as we go along, of course, be sure to stop me and ask. You may have to stomp your feet, although I can't hear that, but I'll try to keep checking back over to the question pane and catch a question if that comes in. So if you lose me for some reason, you can email. I have, let me get out here and close down my Blackboard IM so other students don't. Okay, so how would we account for inventory? The first thing that we need to think about just quickly is how we were in the beginning parts of the chapter, we were talking about service companies. And with these service companies, with service companies, we have service revenue and then our expenses. When we switch over to a merchandising company, or if this were an manufacturing company, which we'll look at when you take Accounting 102, we're going to now have a cost of goods sold. You heard me say that one of the concepts we were going to look at was the gross profit margin. Well, when we're doing a multiple step income statement, which is what this format here with the cost of goods sold on is called. It's called multiple step. You will see that we have our sales revenue less our cost of goods sold. Our cost of goods sold here, and that gives us our gross profit. You will notice as we go forward that the gross profit margin, or the percentage, is our gross profit divided by our sales revenue. And just, cat's not happy. Cat has to be in, now the cat has to be out. Okay. So with our gross profit percentage, we'll be working toward that to see actually how much of our sales revenue it's taking for us to pay for our inventory. And how does it affect the balance sheet? The only difference on the balance sheet is that we now have a current asset called inventory, whereas in a service company we do not. Okay, Glennis, I see your message, and that's fine. I just hope you can at least hear us. Hopefully you can do us on speakerphone here. Because, again, as I say, maybe sometimes you don't feel like you get a lot of value out of this type of an exercise, but just hearing the terminology and having a chance to have have it discussed a little bit is helpful, and often more helpful than you possibly think. So how are we going to account for this inventory? Basically, if I had inventory and it was 100 towels at $3 each, so the amount of inventory I have is 100 units here. They cost me $3 each, which makes my total cost in inventory and the amount that actually shows up on my balance sheet in my inventory as $300. How does that affect my revenue on the income statement? How many towels did I sell? In this case, they're telling me I sold 200 towels. I sold them for $5 each. Okay, this is my sales price. Someone asked the question, is that the sales price or the cost? When it's my sales revenue and it says $5 each, that's how much I sold it for. So my total sales would be 1,000, and then 200 towels at $3 each was my cost because I had them in inventory at a cost of $3. So my cost of goods sold is 600, and the gross profit, or the amount that I have left to apply toward my operating expenses and the amount of income that I get to keep for myself, is $400. So my gross profit margin in this case is 40%. 400 divided by 1,000 is 40%. And then I still have to take off all of my operating expenses, as I say. So, we, in this company, we might want to look at seeing, could we lower either the cost of goods sold here, find lesser costing inventory, or could we potentially raise our revenue by increasing the sales price? Tricky balance that you have to look at when you're in business. How should we account for inventory? We have to look at how the inventory sold shifts from an asset to an expense account. When we buy our inventory, we record that. If I buy it as on account, I would record it as inventory, debit side, increases my inventory account as an asset, and increases my liabilities of accounts payable with a credit, because liabilities increase on the credit side. And then when I sell my inventory, I have to remove it from my inventory account with a credit. And then I need to have an expense account, which increases on the debit side. And cost of goods sold is what I call that account when I sell my inventory. So, and with the question about the sales cost, the sales revenue is based on whatever our sales price is. As we look at some of these exercises that I have picked out tonight, and I know some of the exercises that are in your homework assignments, you see the price of the inventory constantly going up, but seldom do you see the sales price rise. Why do you think that would be, that our inventory prices might change as we reorder, but we don't increase the sales price? Can anybody think of a reason? Uh-oh. Can anybody hear me now? Okay, yeah. Okay, that's good. So anyway, if you're losing sound, it may be your end instead of mine. It looks like most people are okay. So just keep playing with it. So much relates to your equipment and to the speed of your internet. The reason that we probably can't be raising the sales price every time the price fluctuates a little bit is that you assume we would price ourselves out of the market really quickly. If, let's say that we didn't have a big stock of inventory, and so we raised our price by $3 to make up for the cost that went up $1.50, but our competitor had a good stock of that inventory that they had purchased as a lower cost, so they're still selling it for the lesser price. We're going to lose our sales for that. So you're going to have to absorb some change of cost in your business as it goes along. If the price continues to go up, your purchase price continues to grow up, of course you're going to eventually have to raise your selling price. So we want to pay very careful attention to the difference in the sales price and the cost of inventory. This is one of the things that will trip students up as they're working on their homework. It really doesn't trip you up as much in the real world because you clearly know what your sales are and what your cost of inventory are then, but it's, you know, you're not just pulling it as a number off a piece of paper then. So cost of goods sold is actually the number of units we sold times the cost of that inventory. That's our cost of goods sold. And the inventory cost is based on how much inventory is left on hand. I know this is one of the questions a student was asking about that they just weren't getting, and I tried to respond, but you know, sometimes I know that I may not respond in terminology that you understand or in an order that you understand. So if you ask me a question and I respond and you still don't get it, just ask again and I'll try again in try to use different terminology or explain more. Or if I was answering questions last night and I tell you I was running on absolutely zero sleep, and I can get pretty scattered, just as I'm sure you can. So then how does sales price compare to the cost of inventory? We determine how many units we have. We need to know a physical count at the end of the year. We always, at some point in time, we have to physically count our inventory, even if we're doing computerized records by using the barcodes and things. We always have a significant amount of inventory that, you know, I like to say it grows legs and runs out the door by itself, or maybe it just gets damaged and thrown away. And so you have to account for that, and that is part of your cost of doing business, therefore part of your cost of inventory. If it's gone, it's part of the cost of selling goods. If we have consignments or taken consignments, those do not belong to the company who is holding them as a consignment. You don't count them as inventory. If goods are in transit, meaning they're being shipped on the highway, and we talked a little bit about shipping terms before. When you're talking about shipping terms, it depends, or it shows when title passes or who owns it at that time. And so just as a quick reminder, FOB shipping point means that the point when the goods leave the seller's shipping dock, that's where the ownership changes. So shipping point, as soon as it's loaded on the truck and drives away, it belongs to the buyer. And when it's destination, it's not the customers or the buyers until it gets to their dock, actually at their dock. There's two main types of inventory accounting systems. One is the periodic system and one is the perpetual system. The periodic system is where I don't have maybe a computerized method in place, so I actually have to physically count the inventory at all times to know how much inventory I have. Perpetual system is ongoing. It is used to keep record of our inventory on hand. It's good for almost any type of inventory, but sometimes, you know, some things it's a little hard. If I was in the business of selling maybe individual pencils or something like that, I might just want to do periodic rather than keep the perpetual because the cost would be so low and for each item, and it's just almost easier to, or it's not cost effective to do a perpetual system. But we can use a perpetual for all types of goods. We keep that running record, and we have to still physically count or do a physical go out and count the inventory at least once a year to make sure we can account for the missing items. And periodic, we wouldn't want to use it for expensive items. We're not going to track things like vehicles or TVs or something on a periodic method. but we don't keep a running record of our cost of goods sold, and we again have to count at least once a year. So when I'm using a perpetual system, which we see in almost every business in today's world, they have a barcode reader and you scan the code and that records the sale. It updates your inventory records. We need to record two separate entries when we're using a perpetual inventory system and we sell some inventory. We have to record the revenue and the asset that we received for that, which would be either cash or accounts receivables as our asset, recorded as a debit, and then our revenue would be recorded as a credit. And then we must also, the next entry must be, we record the cost of goods sold and the reduction of the inventory account. So we are increasing an expense account and decreasing our inventory asset account. Quick illustration of that. In this case, we would have purchased inventory for $560,000 on account. We made a sale of $900,000, sales revenue credit, accounts receivable debit, and the entry to record the cost of that inventory sold and how much inventory is gone is the very next entry. So that's standard perpetual inventory system process of buying inventory, selling inventory. We can always compute the cost of goods sold, and it's interesting. You'll begin to see more and more as we go through these ending chapters in the book that cost is more than just the sticker price on something. So if I buy inventory, any of the shipping cost or the freight in it takes to get it to me, less any discounts I get for returning goods or just for making an early payment, equal my net purchases and the cost of the inventory. And I'm just going to click through these real quickly. We're just doing exactly what we showed on the other entries. One thing I might note here is when we are getting a discount on an inventory invoice, you notice that we had here terms of 2%, 10, net 30. You should remember that the 2 means 2% discount if paid within 10 days. The full net of the invoice is due in 30. We've had this discussion before, but also notice that the discount here comes directly out of the inventory account. We don't use a discount account when we're doing perpetual. Okay. As we start comparing methods, this is more, you do a lot of homework on this. We need to understand what profits are to be reported, the amount of income tax that we have to pay, the values of the inventory turnover and gross margin percentage ratios. We need to understand and have, at least have a working knowledge of how all of these things work. So again, what goes into the cost is anything it takes to get it to us, fees and taxes that we have to pay, less any returns. We just looked at that as well. There's different costing methods. I know I had some questions already about we had some questions about specific unit cost, not seeing how that exactly worked in average cost and first in, first out, and LIFO. So these methods can all be used. They'll have very different effects. They change your profits, they change how many income taxes you pay, and they change your cash flow. So those are the items that we're going to be looking at and hopefully get a grasp for. That's the type of conceptual information that the multiple choice test questions end up asking for, that you understand, okay, now that I've computed my inventory, what does that mean? Which method can I use to get the highest profit, or what method can I use to have the lowest income tax consequences? And bottom line is, does it even matter in the long run which which method I use. So we have, again, the specific unit. This is going to be unique inventory items such as automobiles, antique furniture, jewelry, real estate, businesses that cost their inventories at specific cost of a particular unit. It's too expensive for these inventories with this would be too expensive for inventories with common characteristics. Like, yeah, I certainly wouldn't use specific unit identification to sell office supplies. And then it's, well, I just call it specific identification instead of specific unit, just another name for it. I like to equate this with items to help you have a good understanding of if I have an item with an identifying number, such as a VIN on a vehicle, you know, the car dealership might have 5 red Acadias sitting out there on the lot, their GMC dealer, and they don't sell you, they don't say, oh, I sold one of the red Acadias. It's a specific VIN number red Acadia that they sold to you, and that is specific identification, and they know exactly which one they sold you. The average cost is we keep track of what our average weighted, well, our weighted average, it is a weighted average. It changes every time you make a sale. If you're doing a perpetual inventory system, you base it on the average cost of the inventory during the period. I'm just going to click through these because I've got examples on Excel that we're going to look at here in a minute that I hope are even more useful. I'm just clicking through these. Like I say, we're going to do real examples that I hope are very helpful. Okay, first in, first out. First in, first out means that the first items that I bought or the costs of the first items that I bought are the first items I sold. It's pretty easy to get the idea of what the flow of the actual goods in a store you would want to be if it were first in, first out. If I had perishable goods and such as produce, I would want to keep that produce as a store owner. I would want to keep that produce rotating so that the first inventory I had bought or my oldest inventory was the first inventory I sold, because that way I don't have as much spoilage. That's how the flow of the goods would go. But when I tell you that we could actually do last in, first out to cost that flow of goods, to track the cost of the goods, it doesn't matter. I still want to be rotating the goods in the store first in, first out. I want the oldest inventory I bought to be the first inventory out the door. But as a costing method, I can choose to do it either specific unit average, first in, first out, or last in, first out. It's not really the flow of the goods, but it's the flow of the costs. So with first in, first out, this is the type of terminology we need to look for. The oldest items assumed to be the first sold, and ending inventory is based on the latest cost incurred. We see those kinds of questions. Again, this is an example which, like I say, we're going to look at. And then costing is the opposite of FIFO. The last cost in inventory go to cost of goods sold first. So the most recently purchased items are assumed to be the first one sold, and our oldest costs are in ending inventory. In periods of rising prices, this causes a huge difference in your sales and your, or not your sales, but your cost of goods sold and your ending inventory on your financial statements. This is an example of everything I had deleted out. Okay, well, look at this little bit of difference. When inventory costs are increasing, and you may see that as something as in periods of rising prices, and then they would ask you a question about that. And so when inventory costs are increasing or in periods of rising prices, FIFO cost of goods sold is lowest because it is based on the oldest costs, which are low. Gross profit is therefore the highest because if I reduce my expenses, then my gross profit is higher. My ending inventory is higher because it's based on the most recent costs, which are high. This sounds like just a bunch of mumbo jumbo, I know, but when we do the illustrations, it should help you to understand why it's saying this. So LIFO, cost of goods sold, is the highest because it's based on the most recent cost, and our gross profit then is the lowest. If my gross profit is the lowest, then my tax liability is lower because I have lower taxable income, and that can save you money, or at least postpone paying taxes. Okay, so our ending inventory is lower. Our cost of goods sold is high when it's based on FIFO. How do I keep track of perpetual inventories? First of all, you need to know it is impossible to apply LIFO unit cost to units purchased and sold as transactions are happening. Weighted average can be quite challenging as well. It requires lots of computer software or lots and lots and lots of hard manual work to keep up with it. So many companies only track their inventory quantities during the period, and then they make adjusting entries at the end of the year by either using LIFO or weighted average. So it's just like anything else. Someone might do even a gross profit method, which we will look at briefly later in the chapter, and then at the end of the year, they go out and do a physical count and then apply LIFO or FIFO that way. I didn't ask, has anyone ever worked with any inventory at all? Ever done any counting of inventory or? Worked a job where you help track inventory? Yes, a little. Yes, some people have counted. And I tell you, my first experience in retail, I started working in a retail place right out of high school and right before Christmas then. And we did inventory on New Year's Day every year, and you went in and you counted a whole store. Yep, every single screw, everything you count, right? Yeah, counting all parts once a year. Fixed assets inventory, in a factory, and inventory's inventory. So, and I was kind of blessed, I guess, if you want to call it that, because I actually, not only did I help do the physical count where you went out and you did all the tick marks on the paper, I got to do the adding up of the tick marks and actually do some accounting and adjusting entries. That was before I had even had any education in accounting, but it just made it so much more logical when I did go to school and start studying about concepts I had already been applying in my work. So tax advantage of LIFO: when prices are going up, it results in lower taxes or lower taxable income, which means lower taxes, and that increases the amount of cash you have to spend. One thing that you often hear is you want to postpone paying taxes as long as you can. So when we compare, just as a little chart about things we've already talked about. So LIFO, managing reporting income, it allows for manipulation of net income. When our inventory prices are rising, large quantity purchased at the end of the year can lower our taxes. Liquidation can occur. Our quantities decrease from last year's. Companies must dip into older inventory layers, and it's not necessarily it's not only not necessarily, it is not allowed under the International Financial Reporting Standards, which, like I probably have mentioned, they were supposed to be in place by now, but they're not. So I haven't heard the update of when they're coming in. So GAAP, we must have disclosure. Our financial statements must report enough information for outsiders to make informed decisions. That's our disclosure. That was from the Chapter 1 we talked about a little bit. We also talked about representational faithfulness, that we have to report relevant and representationally faithful information about itself. We have to properly disclose, typically in the notes of our financial statements, inventory accounting methods, substance of all material transactions and impacting inventory. You do have a couple of financial statements, including the notes in the back of your books in the appendix. So if you've never really looked at an annual report of a company, you might want to look at Amazon in Appendix A and see how the notes would apply and how they explain all the information about their inventory accounting methods. It will explain about depreciation. It will explain about how they recognize their allowance for doubtful accounts and all of that type of information to help the decision makers who want to invest make good decisions. And we must be consistent. So we have to have comparable methods for consistency from period to period. Our financial statement footnotes have to describe our costing method and if it was valued at lower of cost or market, which is another thing some people had asked about. Lower cost of market, this requires that inventory will be reported in the financial statements at whichever is lower, the inventory historical cost or the market value. Now keep in mind that the historical cost is what we paid for the inventory plus any shipping cost to get it in, plus any taxes or insurance we paid, the total cost. That's our historical cost. And the market value means what it would take to replace it now. So if we can go out and buy it for less than what we paid for it originally, then we need to make an adjustment because the cost is more than what the market, and we have to report it at lower of cost or market. So our ending inventory is reported at the lower cost or market value on the balance sheet. That has to be shown that way. And we'll look at this example real quickly. So Family Dollar had paid $3,000 for inventory on June 26th. By August 25th, at their year end, the inventory can be replaced for $2,000. This means that they have inventory on the books for more than what the market value is. So they have to do an adjustment. If they paid too much for the inventory, which in, either it's a popular item and the cost really fell on it or something, then that additional $1,000 has to be added to cost of goods sold because it is a cost of doing business, and they have $1,000 less value in their inventory account. It's just a simple reduction of my inventory amount and an increase of my expense. I report it on my financial statement. I can show it more than one way. I can either say inventory is at market, which tells me that it told me that it was lower than its cost, or I can show, and I can show on my income statement, my cost of goods sold is going to have increased by the $10,000 or $1,000 to make it $10,000. Again, under IFRS or International Financial Reporting Standards, market is always defined as the net realizable value for which the inventory's is current market value. So under US GAAP, once lower cost or market is applied, you cannot change it. The write-downs are gone. You can't reverse them. However, under IFRS, some of these write-downs can be reversed. The inventory might be written back up again. So it's never higher of cost or market once you're in the U.S. Once you write it down, that's where it stays. Our gross margin percentages here are gross profit minus our sales, cost of goods sold. This is a key indicator of the company's ability to sell. We have a markup stated as a percentage of sales, and it is watched very carefully by managers, investors, and this is what I told you earlier in the one example where I said because we had 400 out of 1,000, it was 40%. So the inventory turnover shows how many times the inventory sells or turnovers in a year. The averages vary from industry to industry. You would find this in something like Standards & Poor's or something that's listing industry averages to know what's the range that your type of business should be in. You always have your cost of goods sold divided by your average inventory. To get average, it's your beginning plus your ending divided by 2. Balance sheets would show both the previous year and the current year, so you would have those numbers. And this little illustration here, and again, I'll post these so that you can see the notes that there are notes to these. I'm not really following them, but there's notes, so I'll post these for you to view just as PowerPoint. But if the company had sales of 376 million, and their cost of goods sold was 15,437 million. At the end of 2013, their inventory stood at 1,672 million, and COLA ended 2014 with inventory of 1,908 million. Compute their gross profit percentage and their rate of inventory turnover. Well, for gross profit, you actually calculate your gross profit by sales less cost of goods sold, and you divide it by sorry, the cat's back and she's shoving everything off my desk. So 54 or 56.4% for your gross profit percentage. For the inventory turnover, it's a two-step process. We have our cost of goods sold divided by average inventory to get 8.6 times a year. So if I want to know how many days it takes for our inventory to turn over, I divide 365 days times our inventory turnover 8.6 to say 42.4 days for my inventory to turn over. To make management decisions here, I want to look at how the cost of goods sold model is used. We would have our beginning inventory plus our purchases. That gives us our goods available for sale. You will hear me use this term a lot when we're working on the exercises here in a little bit. I'll say you had this many available for sale. Then you take away your ending inventory and it gives you your cost of goods sold. This is used by all companies regardless of their costing systems or accounting systems. If I am actually using a periodic inventory system, then I don't have an account called cost of goods sold on my books or in my ledger. That's a computed number for my income statement, and this is how I would compute it using this formula here. So if I want to use this to compute how much I should budget for my purchases, I can just rearrange my formula. It's shown in your book in Exhibit 613, but it shows you how you would do cost of goods sold based on how much I plan to sell in the next period, plus any inventory I want to keep on hand. I should always plan to have some, and that's going to equal what I need to have available for sale. And then I subtract my beginning inventory, how much I actually had left over, and it gives me how much inventory I need to buy. And I mean, this is a budget. It's an approximation, but it helps to plan ahead and buy the right amount of inventory. I had mentioned a little bit earlier about estimating my inventory. There could be other reasons to estimate. Maybe I'd had a fire or something in my inventory had been destroyed, and so hopefully with my accounting records backed up off-site, I can actually estimate how much for my insurance company I have lost. So it's just a basic formula as well. You do have a homework problem with this, but it's beginning inventory plus your purchases. That gives, again, your goods available for sale. Can't sell it if I don't have it. If I have my sales revenue and I know that I mark up or that my gross profit is usually 35%, I can subtract that, and that gives me here my estimated cost of goods sold, although I can't draw a circle, and then my inventory lost in this example of where I had lost inventory in some kind of disaster. Okay, so see if you can solve this one for me real quick. See if you've had your thinking hats on. We have beginning inventory is $70,000. Our net purchases totaled $365,000, and net sales are $500,000. With a normal gross profit rate of 40% of sales, how much is ending inventory? Can anybody figure that out for me? I have a guess. Any more? Anybody else trying to figure this? Have a couple answers in. I have 3 different answers so far. So you need a calculator. So how many of us have been ruined in life because we are spoiled by calculators, or I'm spoiled by Excel? Actually, I'm over here popping up Excel to get this done. The answer is 135,000. So we did have a winner. Congratulations, Melinda. You had it right. But the 70 is, and it's just plugging the numbers into the formula. So if you have the formula written down, you should be able to follow those formulas and get something like this correct. Okay. Basically, I think we're coming up on the last concept before we start looking at examples. So how do inventory errors causes headaches? So if our ending inventory in period 1 was overstated by 10,000, our ending inventory was overstated by 10,000, you can see that okay. A second. Okay. So if ending inventory is overstated by 10,000 and cost of goods sold is understated by 10,000, then compare period 1 with period 3, which is correct. Period 1 should look exactly like period 3. Okay, that's what period 1 should look like. So we have our ending inventory has been overstated, and so that makes our error off by 10,000, or our amount off by 10,000. So then what happens when we move on to period 2 is if our period 1's ending inventory is wrong, then that becomes period 2's beginning inventory, which makes the period 1 error carry over into period 2. When we trace it, the ending inventory of 20,000 from period 1 to 2, then compare periods 2 to 3. All 3 periods should look exactly like period 3. This, in this case, the colored amounts are incorrect. So you can see how the period 1 error falls into period 2, but then by period 3, we're right back to the correct amount. It corrects itself, but you're wrong for 2 periods. Okay, so this is just a little check your question. Which inventory system should we use? If we have expensive inventory or expensive merchandise, we should use Perpetual system. If we have, we can control the inventory by visual inspection. We can do periodic. And if it's unique, we should do specific or one-of-a-kind objects for the unique inventory items. And this is just more. Use FIFO to maximize your income, LIFO to minimize taxes, and when it's the middle of the road or you want the middle of the road approach, use average. That's that. Made my computer mad. Close out those PowerPoints. Okay. Okay, let's look here. First, I want to look at a little inventory exercise that I use in the classroom a lot. And like I say, this is the one that I use with candy or with paper clips or something that the students can physically move the items around. But in looking at something that I could do, that we could try to show some illustrations for this. Can everyone see this screen? I think you can, where you should be able to see my numbers, and then I've got some inventory over here. They happen to be pool balls, I guess is what they are. And so what I actually ended up doing was I changed my dollar value in my exercise to be so that whatever the number was on the ball is their dollar value. So what we're going to consider, some things that we have to assume when we're going to do an exercise like this is we're going to assume that this is all the same inventory item. They're all exactly the same. They're just, the color is just representing so that we can tell the difference in what their cost was as we move this inventory to help us get a feel for how the flow of the cost work. So the color would be really all the same. It just helps us to identify these. So for my information here, I had some beginning inventory on January 1st. I had 3 blue items in my inventory. They had a cost of $2. On January 5th, I purchased 5 yellow. They're the yellow, but I purchased 5 more units at $5 a piece. Huge cost increase. On January 7th, I sold 6 items. This $10 it was my selling price per unit. On the 15th, I purchased 6 green units at $6 a piece. And on the 17th, we sold 5 units at $10 a piece selling price or retail price. And then on the 25th, we purchased 4 red. So I'm going to look here. I have periodic method, and then we'll look at perpetual. Now remember, with periodic, it's it's not ongoing, so we're not tracking of, oh, I bought this item here on the 1st and on the 5th, and oh, on the 7th I sold some, so I couldn't have sold any that I bought on the 15th because I didn't have them yet. With periodic, when I sell them, does not matter, okay? It's during the period. So if I want to look at periodic FIFO, and I'm going to try to determine COGS, which is cost of goods sold, I'm going to determine my ending inventory, the cost of my ending inventory, and I'm going to determine my gross margin. Now remember that gross margin is sales minus cost of goods sold. Okay, and with that said, my sales will be the same in every one. How many units did I sell? I sold 11 units at $10 a piece. So my sales are always going to be $110. Let me remove these zeros. Okay, make my column smaller here. Okay. Again, with that said, we're doing periodic FIFO. So, and I'm going to ignore when I sold them because it's periodic. So FIFO means the first ones I bought, or my oldest cost, are the first ones I sold. So I need to determine which of my costs are cost of goods sold and which of my costs are ending inventory. Here, with periodic, we determined we had sold 11. I'm going to start with my earliest cost as my cost of goods sold. So I'm just going to, yeah, I probably can do this. Let me just say, okay, so to move which ones I would have sold these 3. That's 3. Here's 4, 5, 6, 7, 8, 9, 10, 11. So these are my cost of goods sold, the 11 I sold, and these others remaining are my ending inventory, okay, or the cost of my ending inventory. And as I said, I set this one up so that their cost is actually on them. So hopefully we can add and come up with these numbers. I can also multiply and do the math without counting, but I'm trying to get you to have a visual of knowing which they sold and how the flow works. So does everyone see how I counted these off to show which ones are my cost of goods sold and which ones I have left? Does that make sense? Okay. So now let's add it up. Can somebody add me up the cost of goods sold and somebody add up the ending inventories? Sold is 49. So 49. 46 in the inventory. And if that's the case, then I have sales of 110 minus my cost of goods sold gives me a gross margin of 61. Is that what you all agree? Somebody says 15. Without me actually adding these up, which I could do really quickly, but another thing I can do is I can determine how much I had available for sale, which I will need to know eventually anyway. So how much did I have available for sale? I had 3 times 2. So I'm just multiplying these across. Okay. If I had $95 worth of units available for sale this month, then my cost of goods sold and my ending inventory should equal $95, right? And that does equal $95, so I'm going to assume that's correct. Okay, let's look really quickly here at moving these back. This isn't ideal, but it still gives you a little bit of an idea of how this can work. Okay, so LIFO, the last ones I bought are the first ones I sold. I still sold 11, right? 6 and 5. So these 4 are sold. 5, 6, 7, 8, 9, 10, 11. So these are my cost of goods sold, and this is my ending inventory. So can you give me those numbers? $26 for my ending inventory. That's what you guys are telling me. And $69. Again, that adds up to $95. So we should be good there. I have $110 minus my cost of goods sold. My gross margin is $41. Average cost. With the average cost and periodic method, I really don't need to move my inventory around so much for you to see. I just need to do some numbers. And I can do those calculations real quickly. Because we just have to get an average unit cost. To do that, I had $95 total cost. I had 18 units available for sale. My 3 and 5 and 6 and 4. To get my unit cost, it's 95 divided by the number of units. My unit cost is 5.27. This is my unit cost, average cost. So then I sold 11. My cost of goods sold is 11 times my average cost. If I sold 11, then I have 7 left. 7 times my average cost. That should equal 95 if I add it together. 110 minus my cost of goods sold equals 52. So did that make sense to everybody for the periodic? Okay, let's change this up and look at perpetual. Let me hide these. That makes sense. Okay, good. Let me hide this so that I have okay, so we can keep it all more on the same page. Now, for perpetual, It's ongoing. So we have to look more at what we have. So, or when we buy it. So I'll just move these over a second. Stack them up for here. Okay, so for FIFO, I need to know my cost of goods sold. Nothing much has changed here with the scenario for FIFO. I had a beginning inventory of 3 units, so I'm going to pull these over here. This is what I have. This is my available for sale today. If I ask you right now, what is the cost of my inventory, you would tell me the cost of my inventory is $6. That I had 3 units and the total cost was $6. And then my next on the January 5th, I purchased the 5 yellow. I'm going to pull those down. So right at this moment, my available for sale is going to be a total cost of $31, and it is 8 units. Okay. Then what happens? We sold 6 of them. Which 6 did we sell? When I'm doing FIFO, I can't sell these because I haven't bought them yet. They're not in my inventory yet. So first in, first out, I sold 6. So I sold this, the 3 first ones, and 3 of the next ones. Okay. This is still my available for sale. I haven't purchased these yet. Then I purchased 6 green ones. So these are becoming available for sale. Okay. And then I sold 5. Which 5 did I sell? I sold these 2 remaining here and 3 of these. And then I purchased 4 more items. So this is my ending inventory. Right? This is my cost of goods sold. Over here, all of these. Okay? So we need to add those up. Ending is 64. Sold is 49. Okay, something's wrong because 49 and 64 is too much. So these numbers aren't right. Somebody said 51. Ending is 46. Okay. Okay, the ending is 46. All right, that'll add up to 95. Our gross margin, our sales were still 110. That didn't change, minus our cost of goods sold. Okay. That felt a little painful. Okay, LIFO. I had my fin beginning inventory. I purchased the next 5. Okay, that's what I have now. Now, I sold 6 LIFO. Last ones in are the first ones out. So I sold my last ones. 5 of them, 6. Right? So these are my solds down here. Then I bought 6 more. And I sold 5. Which ones did I sell? The last ones I bought. And then I bought 4 more. So these items over here are the cost of my 7 ending inventory items, and these are my cost of goods sold. Can you add those up? That's all right. Someone twisted their numbers around. Transposed numbers, I do that all the time. I transpose letters too. So anyway, can you add me these costs? Cost of goods sold, ending inventory. So I get 38 ending inventory from someone. And a 57 COGS. That adds up to 95. Everyone's getting that? Yay! So net income, or not net income, gross profit. Okay. Now one last, the average cost, and then I have one specific problem to look at that someone asked about, and I'll open for questions. Okay. With the average cost, it's not going to do me too much good to move my items around. What we need to keep in mind is that we can't sell what we don't have. We have to calculate a new average every single time that we are going to sell a piece of inventory. So we start out and we had our 3 blue, we bought our 5 yellow. Those added up to a total cost of 6 plus 25, and it's a total of 8 units. So we're going to do 31 divided by 8, the cost divided by the number of units, and our average unit cost when we make this first sale here is going to be $3.87.5. So we sold 6 at that cost. Okay. And then that leaves us 2 items. We still have 2 at an average cost of $3.87. That's what we have in inventory right now. Okay. So this is our cost of goods sold. And this is our ending inventory. And then we bought 6 more green ones at $6. So we bought 6 at 6. And then we turned around and sold 5. So we have to calculate a new average cost between these two. So we have 2 at $3.87. And we have, this is 36, but 6 times 6 gives us $43.75 divided by, again, we have 8 units. Okay. And we sold 5 of those. So we sold 5. I don't know where I got 31 here. Oh, that was my total cost. Okay, never mind. I do know where I got it. So actually what I sold was 6. And then we sold 5 at 5.468. And then that means we had how many left? We had 8. We sold 5, so that means we've got 3 left now at 568. So our ending inventory and we have 4 more that we had purchased at 7. Okay, and my cost of goods sold, I can just add this up, 50.44, 50.54. Have I lost everybody? And then my cost here, so because of rounding, we're a little above the, well, that's not right either. So I've lost myself somewhere because that's not right. How do I know it's not right? Because it's more than $95. It can be a little more because of rounding, but something's not right there. Do I have 9 left? No, I shouldn't have 9 left. I only have 7 left. So I have 3 of these. There I go. I only had 3 left from this last sale before I bought my last 4. Okay, so average when I'm doing perpetual is harder, right? Would you agree? Yes, wow, yes. Okay, I know I made that look a little more confusing than it really had to. But bottom line is I can't really sell what I don't have. So I had bought these 3 or these 8. I had these 8 items. I sold 6. I had to calculate an average. I bought more. I had to calculate a new average cost when I was getting ready to sell again. Okay? And if I totally confused you, I'm sorry. Then here's an inventory example that's actually straight from the homework. Okay, you were giving some information about beginning inventory, a purchase, and then another purchase. Does this look familiar to anybody? It wants to know as of July 31st, and maybe I can make this a little bigger. Okay, so straight from homework, let's look at this and see if this makes sense. It's right out of my accounting lab. So we had this information given, and it tells us as of July 31st, 10 of these programs are on hand. So we compute the cost of goods sold and ending inventory using each of the following methods: specific identification or specific unit costs. It tells us we have 5 units, or 5 of the $150 units and 5 of the $160 units still on hand. That means that will be my ending inventory. It means I have 10 units in ending inventory. How many units did I have available for sale in total? Again, I can add how many units I had. That was 24. So if I had 24 units and 10 of them had sold, or 10 of them were left, that means I sold 14. That's going to be the first thing. I have to determine how many units I sold and how many I had in ending inventory, and it told me I had 10 programs left. Then under the specific identification method, it told me that I had 5 at the 150 cost and 5 at $160. So if I need to have my cost for cost of goods sold, well, first I can compute my ending inventory because it's 5 times $1.50, or 150 plus 5 times 160. I can let Excel do that math when I'm here. Okay. And, from this point, using the available for sale like we were doing, I can look and I can just say, well, my total available for sale is $37.44. So I could do my math that way. I could say, well, then it has to be the difference between my available for sale and my ending inventory. That's one way. Another way is I can actually look and see what those are. If I've sold 5 of my $150 unit ones, then that means I still have 1 at 150. And if I didn't sell any of the 4 at 151, right? And I would have sold 5 of these 14, which means I have 9 left. Or not 9 left, it means I sold, I don't even know what I did. I sold 5 of them, or I still have 5 of them, so I sold 9. Long day. Do my math, add them up, and you will see that that equals the same thing as I got for my specific identification. I'm just trying to show you that there's built-in check figures on so many things if you just know how the formulas work. This one, because of the way we need to work this with our average cost, we don't have any dates of when we sold, so it's much easier to compute our average cost. We had a total cost of $37.44, total units of 24, divide the cost by the units. All right. Our average cost is $156. We sold 10, or our ending inventory is 10. I keep saying we sold 10, but that's what we have left. And we sold 14. Again, if I want to see if these add up to my available for sale up here, I can put in a little check column just to see that. And that's what I'm doing. I'm making sure that this equals my available for sale. FIFO, with the FIFO, the first ones I bought are the first ones I sold, right? I would have sold 14. Which 14 did I sell? I sold 6. I sold 4. And I sold 4. 21.44. Okay, because the first ones I bought are the first ones I sold. 6, 4, and 4 to get to the 14 sold. That means I have 10 units left at 160. Okay. Again, I can check my math to make sure that's right. Then LIFO, the last ones I bought are the first ones I sold. I sold 14, so I sold these 14. $22.40. What you need in inventory would be these two numbers added together. And that's that. And I know this is one that I've had a couple of questions on about a couple of questions from more than one student about this question in Ask My Instructor. So did that help? Does that clarify how that works? Because I know one thing, and when I worked this first in my accounting lab, I didn't notice that it had this information after the specific unit cost. Any specific questions? Okay. No specific questions at the moment. As you know, you can go ahead, not really. Okay, when you get into your assignments, hopefully it's not late Sunday night when you get started. So go ahead and get started on your assignments so that you have time to ask